everyone. Welcome to VRIC Media, your most trusted voice in metals and mining. I'm your host, Darrell Thomas, and today we have the pleasure of interviewing Professor of Applied Economics at Johns Hopkins University, Steve Hanke. How are you doing today, Professor?
Doing well, Darrell. How about you?
I am doing pretty good. And so let's go ahead and start off with gold. And gold has seen a sell-off since we've talked. It's struggled to kind of perform well. And so just want to get your perspective and how you're viewing gold at this time.
Nothing has really changed in terms of the long run view of the secular bull market. We're still in it as far as I'm concerned. And I think we will go up to, around 6,000, peak out around 6,000, something like that. And I agree. It has pulled back, but it's pulled back in the face of very strong dollar and higher interest rates. I think that those have been the two big headwinds. And there's also been some pivoting out of temporarily out of commodities into tech. That's the big picture. But you still have almost all the central banks indicate they're going to be buying. China's buying big time, and I think the basis for higher prices is all pretty much baked in the cake.
Yeah.
So it's from that point of view, it's a good buying time.
Mm-hmm. Do you see central banks buying? Do you think that's putting the floor under the gold price measured in dollars?
Yes.
Yeah. I've been kind of thinking that too, because it seems like the buying has been increasing. Obviously, with the disruptions with the Strait of Hormuz and such, we've seen some selling. Some analysts were saying, "Oh, gold is being sold to, because they needed energy or things of that nature." But it seems like a lot of that has kind of died down, and the buying is back on, from what I've been seeing.
Well, it seems to be consolidating now. It's up, almost 4,200 today, and as we speak, and on the 7th of July, 2026.
Yeah, we got to put that date in there, the 7th of July.
Yeah.
So on the 7th of July, I got to ask you, what's happening with money supply? I'm seeing a couple of charts that are showing that M2 money supply is increasing in the U.S. as well as globally. Curious if you're seeing the same thing. What's your thought?
Yeah, the money supply is accelerating. If you use the Fed's M2 number, which is just a simple sum of the components that make up M2, you just add them up, and you get a number. That's M2, and that's been accelerating for roughly about 18 months, something like that. Now, one of the aspects and a big driver in M2 are loans made by commercial banks, and those have accelerated considerably. So that component is really driving the increased rate of growth in M2. If you look at it more broadly, and I think a better measure is what they call Divisia measures, where you take the components, instead of adding them up in a simple sum, you put weights on the components that make up the money supply measure that you're looking at, whether it's M2 or M3 or M4 is even better. And that we can get those numbers from the Center for Financial Stability in New York, where I happen to be a advisor. And they use what they call Divisia. And they measure the money supply, obviously M2, M3, and M4. M3 and M4 aren't measured by the U.S. Government anymore, by the Fed. And M4 really is the best one, because that includes all the way out to T-bills are included in that. Now, the T-bill weight isn't as great, obviously, as currency, because T-bills aren't currency. You can't go into a grocery store with a T-bill and buy groceries. Mm-hmm. You've got to exchange the T-bills for cash or money that you end up putting in your checking account that have a bigger weight, have more moneyness. So the idea with Divisia is you put weights on the components, and the weights are geared towards the degree of moneyness that is included in the component that you're including in the major money supply that you have. So Divisia M4 includes a lot of components. Each of them is weighted, with T-bills being the last one in the line on M4 and having obviously a much lower weight than cash or currency or checking deposits, liquid deposits, or savings deposits. So as you go down the line, currency would have full weight, then checking deposits a little less weight, and then savings deposits, short-term savings deposits, a little less weight, and long-term deposits even less weight. But they're all moneyness because you can exchange all of those components actually into cash and use it for transactions. So anyway, that's a little bit of a long-winded answer to your question, but if you really want to get at the money supply properly, the best way to look at it is with Divisia measures, that you have these weights, and look at it as broadly as you can with every asset that has moneyness in it included, and that would be the M4 measure. And you can find this. Just go to your website, Center for Financial Stability in New York. They publish this every month. They have a very detailed monthly report on this. Now, what's going on there? What's going on there is that the money supply, measured by Divisia M4, is growing more rapidly than Hanke's golden growth rate of 6%, a rate consistent with hitting a 2% inflation target. So, as I recall, the last month's measure was about 6.7% year over year for Divisia M4. And what's that mean? That means the inflation genie is out of the bottle, Darrell, and it's not going to be put back in the bottle. All these measures are accelerating. The growth rate is accelerating, and that is the fuel for inflation. It's also the fuel for asset prices going up,
Yeah.
and the real economy to stay on track. Because ultimately, what you have with the quantity theory of money, if you look at the money supply, focus on the money supply, and relate changes in the money supply to the end game, and the end game is what? Nominal GDP. And nominal GDP has two components: real growth and inflation.
Mm-hmm.
So right now, we have real growth, not too bad, looking okay, and we have inflation. Of course, we have quite a bit of inflation. The CPI is at 4.2% year over year in the United States. That's over double the inflation target of 2%.
Yeah. So I was doing some reading, and I guess there was some talk about the Fed increasing their inflation target to 3%. There's been some pushback on that, and I know that Kevin Warsh has come in as kind of seemingly a hawk, and I've heard from some people that he's actually an Austrian, believes in the Austrian economics and such. How are you making? How are you processing the Fed and their involvement with creating the base money? Their balance sheet has been growing and such, and so what kind of sense are you making of that?
Well, right now, Warsh has just come in. He's only publicly had one press conference, and the interpretation of that talk that he gave, the press conference, was that he was hawkish and in tone, and so that's kind of where the market is right now. We'll have to see, because he's not the only one that's voting in the open market committee. So I don't think things probably are going to change radically that fast. There might be changes. There will be changes. He's a new chairman, and I hope he orients himself towards the quantity theory of money. He's indicated that he wants to change things, and he wants to change the model that they use, and I think that's a great thing. He has a task force looking into, for example, squeezing down the balance sheet. That's great, but that's a great idea to open the door, take a new look at things. Obviously, things haven't worked very well because the Fed under Jerome Powell was a disaster. I mean, we've just been on a roller coaster ride with a huge increase in the money supply after COVID. Then we had a big increase in inflation as a result of that, and then they slammed the brakes on, and things started coming down. And now it's things are going up again. They took their foot off the brake. Remember, we had quantitative tightening until December of last year. Now we have quantitative easing.
Yeah.
So they're looking at the data that come out every day, and the model that they have excludes the quantity theory of money. They don't even measure the money supply and have that measurement included in the post-Keynesian macroeconomic models that they have. So I hope Warsh sees the light and says, if we're gonna hit the inflation target, whatever it is, we better be keeping our eye on the quantity theory of money and the money supply. But he hasn't really said that explicitly yet. Now, Jerome Powell, on the other hand, did explicitly say over and over again that the Fed did not look at the money supply because, as Powell put it, he claimed there's no reliable relationship between the money supply and economic activity, which is, of course, nonsense.
Mm-hmm.
But that's been the position, and Warsh says he wants to change that, but we don't exactly know what he has in mind, so we just have to wait.
Okay. Curious in your thoughts on the recent Supreme Court ruling about the president can't fire a Fed chair. And I bring this up because, Warsh is coming in as this hawk, and many people in our sector believe that, oh, well, the Fed's going to cave into the political pressure and they're going to print more money and such. And so now it seems like that Supreme Court decision may have did a blow to some of the political pressure that the Fed may have from either party. And so curious in your thoughts on that.
Well, the Supreme Court decision basically puts us back to status quo ante. It'll be like it was from 1913 until Trump entered the White House and threatened to change things.
Yeah.
So you basically have the establishment of the Fed, and the political relationships between Capitol Hill and the White House and the Fed have always been more or less the same. I mean, the idea that there are no politics and that the Fed is independent and kind of isolated in a bubble, it's ridiculous. But what Trump did, he said he wants to change around. What it used to be it used to be eyes in, fingers out. Eyes in, fingers out. That was the old modus operandi. And Trump said, no, I want fingers in.
Mm-hmm.
I want eyes in and fingers in. He basically wanted to be the chairman of the Fed, de facto. And the Supreme Court says no.
Yeah, with the back and forth with him and Jerome Powell, that was pretty interesting, and it put the markets on kind of on its heels, like, oh, this is like we haven't seen this in a long time. This public display of a Fed chair and a president going back and forth, and then obviously the attempting to fire the Fed governor. And So Trump, nominated Warsh, and Warsh is in there and such. And many people were like, hey, Trump wants to lower interest rates. We're paying too much interest on the debt. We have these other initiatives where this interest expense could be going to something else more productive. And he's told the press multiple times that interest rates are too high. He wants interest rates to come down. But the way Warsh is talking, it seems the opposite of what either Trump wants, and I don't know just kind of what that even entails, like as far as that dynamic.
Again, we don't know what the model is that Warsh has in his mind. I'm not certain he has a clear set of ideas about this, but I do. And if you look at the book that Matt Zuckerke and I wrote last year, Making Money Work, you'll see it, the whole game plan kind of laid out, with the quantity theory of money being at the heart and soul of things. And that simply means that significant changes in the money supply affect asset prices, they affect real economic activity, and they affect inflation. So you keep your eye on the money supply. And if you want to lower interest rates, the best way to do it is today is to keep the money supply growing at around 5 or 6%, measured by even the Fed's measure M2. Let's use M2. We could use Divisia M4. By the way, those growth rates are more or less the same, as long as interest rates are pretty steady and relatively low. The Divisia measures and the simple sum measures are pretty close to each other. When you get real high interest rates, you get huge divergence between Divisia and simple sum measures, because the opportunity cost of getting out of something like a treasury bill or a money market fund and transferring it into cash, exchanging it for cash that has more moneyness, is very high. So if you look at, for example, when Paul Volcker was chairman of the Fed in Reagan's first term in 1980 to 1984, of course, what was going on? We had very high interest rates. We had Volcker, who was looking at the money supply and the quantity theory of money, and he was also looking at the simple sum measures for the money supply, and he thought they were coming down just about right. But the trick is the Divisia numbers were way lower than the simple sum numbers. The growth rate, actually, the money supply was contracting massively. And the reason for that was you had those high interest rates. No one wanted to get into money, into cash, that would be used in transactions. They wanted to keep their money in money markets or savings deposits or T-bills that were yielding very high rates of return. So, speaking of Volcker, by the way, this would be one thing in the way the relationship has been with the White House and Congress and the Fed. Again, eyes in, fingers out. That was really the case with Reagan, because Reagan gave Volcker the authority. He said, just kill inflation, and I'm not gonna bother you. You take care. You know how to do it. You kill it, and that's what Volcker did. What Reagan had very little interaction in terms of fingers in when Volcker was the chairman.
Mm-hmm.
He was the most laissez-faire when it comes to the Fed of virtually all the presidents. Clinton was pretty much that way too.
I've been researching Calvin Coolidge. I thought he was pretty laissez-faire.
Calvin Coolidge was pretty laissez-faire.
Yeah. He was like, hey, government out.
yeah. Keep the fingers out.
Yep, for sure. All right, so interest rates. So obviously the bond yields have been, elevating, retreating a little bit and such. We discussed like whether the Warsh or whatnot wants to, reduce rates or keep rates low, and how to reduce the balance sheet at the same time and such. I've been seeing two schools of thoughts. So one school of thought is interest rates are going a lot higher. Another school of thought is interest rates are going a lot lower. And so obviously lower interest rates typically benefit, commodities like gold and such, so on and so forth, assets and such. But then we have this inflation genie, that's out of the bottle, and it's coming and rearing its head again. And so, where do you think interest rates are going? Because obviously the Fed has so much control over it, and then you have the market that sets rates as well. Where are you seeing interest rates going?
Well, it depends on where you are in the yield curve. The real short rates are the Fed that has control over those with the Fed funds rates. But if you go out to the 10-year, for example, they don't. The 10-year follows inflation and inflation expectations, and the market sets that, not the Fed. And if we look at it today, July 7th, the 10-year now is up. It's 5.1%. It's gone up again. It's over 5%, and I think it's going to go higher.
Mm-hmm. Okay.
The interest rates on everything, but the real short end, the bill rates will be drifting up because interest rates follow inflation, and inflation follows significant changes in the money supply. So it's a pretty simple thing. If interest rates follow inflation and inflation is generated by changes in the money supply, we started out by saying the money supply is accelerating and the inflation genie's out of the bottle. And if that's true, if that holds, the interest rates are going to be elevated. They're going up.
Mm-hmm. So would you loan the government money at 5.1%? Or what interest rate would it have? What would the interest rates have to be for Professor Steve Hanke to the government money?
Well, again, it depends on what you're buying. If you're buying bills and you're getting 5%, that's pretty good.
Yep. What about the long end of the curve? Like,
no, I'd stay away from it.
Stay away from it. Okay. Yeah. This interest is
if interest rates are going up on the longer end of the curve, let's just say arbitrarily the 5 years out, if interest rates are going up because you anticipate inflation is going up, the price of the bonds are going down. So why would you invest in those bonds and incur a capital loss? Of course, you can hold them until maturity. Mm-hmm. That's a different thing. But if you bought them and you wanted to get out at any time before maturity, and interest rates had increased over that period of time, whatever it is, your holding period, you'd lose money. You'd have a capital loss.
Yeah, for sure. Okay, so you're not looking to loan the government money.
No, I think I'm bearish on bonds.
Okay,
I'd completely stay away from bonds.
Okay, so the issue of the interest expense, like, is this I mean, obviously it's a big part of, the deficit and such. The government's paying, over $1 trillion in interest a year. And obviously the long end of the curve is increasing, which could increase those costs. And then there's also some other dynamics with rolling over debt and things of that nature. Does this interest expense of the government, like, what does this lead to? Does this become a major political issue at some point? What are your thoughts on this?
Well, it is a political issue because now about 22% of the taxes we pay go just to pay interest. So the taxpayers, the current taxpayer today is getting only, let's say, 80% of what they're paying in taxes is going either for government services or government transfer payments. about roughly 20%, slightly over 20%, is just going basically down the rat hole because you're servicing past debt. And the key thing with the deficits and past debt is that debt was incurred a long time ago, or sometime in the past. You and many people paying taxes weren't even voting. Some weren't even born when the deficits were incurred. So it's a completely, I would say, immoral thing to be running these deficits, because you have many people servicing that debt who didn't participate in any way, directly or indirectly, in the decision to incur the debt in the first place.
Yeah.
So that the whole thing is bad from, let's say, from an intergenerational equity point of view. It's bad from a moral point of view. It's bad, and from do you get anything from that's worth anything from the taxes you're paying in? And right away, I'm telling you, 20% is taken off the top just to service past debt that's been incurred. So it's becoming an issue because it's big, and by the way, it's now that expense for servicing debt interest is greater than the huge amount that we spend on defense.
Mm-hmm.
And historically, there's something called Ferguson's law. Ferguson's law says that anytime interest expense exceeds defense expenditures, the empire goes south. It's bad news. It puts the government power in throws it into question. Let's put it that way.
Yeah. Okay. So what do you think investors should be? I mean, we're July now, right? We just had the 250th anniversary of the United States and such, which was actually like, sometimes I could be very critical of Donald Trump, and I thought his speech was one of the better ones I've heard, and I appreciated him acknowledging the veterans and folks that served in World War II and so on and so forth. Some folks were looking for like a gold revaluation, thing, and that didn't happen. So that was kind of cold water poured on some of those dreams and such. What should investors be thinking about, for, the rest of this year? Do you think anything significant is on the docket that we should be looking for?
I think we have started a commodity price super cycle. So you want to be pivoting into commodities, more weight on commodities relative to other asset classes. One asset class that I would stay away from, obviously, is bonds. We've talked about that. So that would be a pivot point. I'd be pivoting out of bonds and into commodities.
Yeah. Okay. That's good to know. Okay. So you've been working on some new stuff. You're always writing and always, producing some new content, writing books and such. Are you at liberty to share like what you've been working on?
Yeah, the one thing I'm working on, in fact, when we finish, I'll go down to the office at Johns Hopkins and put pen to paper on some edits on a book manuscript that Dr. Kurt Schuler and I are doing called Currency Boards for the 21st Century. It'll be out later this year. And that book, by the way, is one currency boards. What are currency boards? That's what we're looking at, the history. It's a long treatise. We've been working on this thing for about 30 years. Wow. And we looked at every currency board that's ever existed since the first one in 1848 in Mauritius, and none of those have failed. And what are they? They are monetary institutions that issue local money, and that local money trades at a fixed exchange rate freely, full convertibility, with an anchor currency, and it trades at that anchor currency at a fixed rate. And it's credible because the anchor currency reserves that must be held are equal to 100% of the local currency that's being issued by the currency board. So the local currency is just a clone of the anchor. If you don't like the local currency, you can exchange it at a fixed exchange rate for whatever the anchor happens to be. It could be gold, by the way. I've recommended gold for Turkey, Iran, and Russia, but typically a lot of them have been British pound sterling or U.S. dollar. Now, the biggest one by far is Hong Kong. Hong Kong's currency board has been in place since 1983, and the record, as I say, is perfect. So we're going through the history of this, and in the end, advocating that most developing countries, or emerging market countries as they call them today, should replace their central banks that have discretionary monetary policy and put in a currency board, because currency boards never fail. They always generate stability, low inflation, low deficits, because the currency board can't create credit. It can't loan money to the fiscal authorities. It can't loan money to the government. So you end up with lower inflation, uh, lower deficits, higher economic growth, and it's just a win-win. Now, I've been advising the Trump administration on a dollar strategy. How do you expand the use of the dollar worldwide? And one way to do it is to have dollar-based currency boards replace local central banks in places, for example, like a key place would be Venezuela. Venezuela has the highest inflation rate in the world. It's now a little over, it's about 450% per year. And I've written a book about Venezuela. I was the advisor to the Venezuelan president, Rafael Caldera, in 1995 and 1996, and recommended that they put in a currency board then. They wouldn't have the world's highest inflation if they would have done that.
Mm-hmm.
They would have an inflation rate that's approximately what it is in the United States. So that's the long and short of the book that I'm working on right now with Schuler, and it should be done by the end of the year.
Quick question. So when you're advising these other foreign presidents or just presidents in the U.S. on economic policy, what are kind of the biggest barriers to them implementing some of your recommendations? And obviously, I'm sure you got some examples where they followed your recommendations and seen some improvements and such. And so, what does that look like?
Well, if you want to get rid of a central bank that has discretionary monetary policy and replace it with a currency board that has no monetary policy, currency boards have an exchange rate policy. It's fixed, but they have no monetary policy. The pushback. What's one group right away? Central bankers. Another institutional pushback. A lot of pushback comes from the International Monetary Fund. They want central bankers in place, and in fact, they want jobs for the boys. Now, how do you get jobs for the boys? You've got to have a central bank with discretionary monetary policy that needs advice from the IMF. Or the one that goes into a crisis periodically. You don't have banking crises or balance of payments crises with currency boards. But the business of the IMF is to come in firefighters when there's a crisis. They come in.
Yeah. Yeah.
Now if there's no crisis, well, there are no jobs for the boys.
Yeah. So it's the job security they're looking out for.
Yeah, right. So that's the kind of pushback. What you need is a leader who sees the problem and wants to fix it, and has the courage to do it. Now, we talked about Hong Kong. Why did Hong Kong put in a currency board in 1983 when they were in crisis? Because Maggie Thatcher, remember, Hong Kong was still a colony then. and who called the shots? Maggie Thatcher. She was Prime Minister of Great Britain, and she said we're going with the currency board after being advised to do so.
Yeah, yeah. Okay, well, thanks for sharing that with us, Professor. I encourage everyone to go check out. Obviously, Professor Hanke is contributing to the Fortune articles and magazine, and has some books out. Encourage you all to go check it out. Obviously, the interviews that he is, a guest on, check those out as well. Professor, appreciate you for your time. Know you got some work to get to and everything. Thank you for joining us today.
Oh, you're welcome, Darrell. They also can follow me on X at Steve_Hanke. I've got 852,000 followers, and I'm pretty active on X.
Yep, for sure. I love the graphics you're putting out to share some of your views, and so I love it.
Good.
All right. Well,
have a good day in Boca.
Yes, we'll do. And you all be sure to hit the subscribe button if you haven't yet. I'd love to have your support. Thank you all for watching.